Hello and welcome to the second episode of Meet East Capital. East Capital is an active asset manager specializing in emerging and frontier markets. And during this webcast, we're going to be taking a look at how markets performed in Q3 2023, and then discuss some sort of general thoughts about what we see coming up. Today, it's Monday, the 9th of October. My name is David Nichols and I'm a portfolio manager for the Global Emerging Market Strategy.
And I'm Jacob Grappengieser, Chief Investment Officer of East Capital. I'm here in Dubai meeting companies and brokers on my way to Sweden.
Yeah, so if we look at the headline numbers for Q3, obviously quite a difficult quarter for all global asset classes. Emerging markets actually moderately outperformed developed markets, returning minus 2.8% in US dollars compared to developed markets, which returned minus 3.4%. I think one of the really bright spots was actually frontier markets, which was up 2.1%, so outperforming developed markets by 5.5%. And that's quite consistent with our view we've had for a while, that frontier markets can offer much lower correlation with global markets than frontier markets. But of course, if we look at the main driver of returns in Q3, it's the rising yields in the US. And that's as the Fed's higher for longer sort of stance was gradually priced into the bond markets, with the US 10-year Treasury yield surged from 3.8% to 4.6%. I think it's interesting to look at this from a historical perspective. You know, we've only seen rates this high in 2006, 2007, and then as far back as 2003. So these are really historically high yields we're seeing, and such yields have a number of implications. You know, you have higher discount rates, which should in theory impact companies with cash flows that are quite far out, and just higher cost of capital and debt costs for really all companies across the board. It's also a serious headache for emerging market central bankers because these countries are generally doing well, don't have serious inflation problems. So central bankers are keen to cut rates, but actually are conscious that this could cause more capital outflows as money moves to sort of the attractive yields in the US, which could then weaken the emerging market currencies more, and which is an inflationary pressure, which typically central bankers don't like. I think this is no more obvious in China, as we're showing here, where the spread between US and China rates is close to record highs. And again, we haven't seen this since sort of the early 2000s.
And maybe if I follow up a bit on China, I recently relocated to Hong Kong, and I spent a lot of time in Shanghai and Beijing in the past month. I held a number of very high-level meetings, especially in Shanghai. And my first impressions, I think, would be the following. So first of all, China is entering into a new growth phase. We're no longer going to be talking about 5 to 7% growth for China. 3, 4, maybe 5% is the new level. I think the Hong Kong listed and the US listed shares are priced for this, so they're priced even lower. But still on the A-share market, the local markets, some stocks are perhaps looking a bit expensive if you take this new growth paradigm in mind. In terms of geopolitical risk, I would probably say that the further away you come from China, the higher the geopolitical risk premium, and especially so in the US. Many companies actually have dual listings, so maybe their main subsidiary are traded on the A-share market, on the local market in China, and they can be a 2, 3, 4 times difference in valuation. So you can buy a Chinese company listed in the US at 5 times earnings, and you can buy the same company on the A-share market at 15 times earnings. That's, you know, in our financial markets, a crazy arbitrage. It's not that simple, but that maybe shows you something about the risk level or the geopolitical risk level that US investors put on, especially US investors put on the Chinese market. I think we need to mention Taiwan and the risk of a possible maritime blockade by China, etc. First of all, it's very hard to tell, and I think no one really knows what's going to happen. But I can only tell you this, that if you speak to the leading local investors, they put a much lower likelihood of anything happening in the next couple of years between China and Taiwan compared to what the Western or the US investors think. The Chinese economy is not doing that well. The government is trying to stimulate the economy in different ways, but you're not going to see for example, a US-style stimulus. It's not going to be the big bang in terms of a lot of big measures at the same time. It's going to be Chinese-style, small, incremental, but consistent stimuli. So they will cut the interest rate by 10-15 bips every time, but they're going to do it a number of times. And of course, what they're trying to prop up is especially the Chinese residential property market. 80% of Chinese household wealth is invested into the residential property market compared to 30% in the Western world. So this is going to be the big issue, how to shore up the residential property market. I think they probably will, but it's going to take some time and it's going to be a bit of a bumpy ride. The other maybe topic or problem for the Chinese economy is the local governments. They were to a large extent financed by land sales to developers. That is not happening, and now you're seeing them effectively being bailed out by the central government. That's good because it's a problem that needed to be solved, but this is happening now. And I guess finally, when is the Chinese economy gonna come back? I think in the middle of next year. A lot of savings and buffers were burned through during COVID. The government did not provide much money to support the businesses nor the consumers, and hence you need to rebuild your savings before you feel confident again. I think that's pretty much consensus from everyone you meet in China.
Okay, maybe just to add very quickly from my side, I also met sort of 16 Chinese companies here in London. And I think one of the things that really struck me on the positive side is actually that while the domestic economy is still struggling, as Jacob mentioned, actually on the export side, it's doing incredibly well. And I think the best way to look at it is look at external trade balances, which before COVID, we were around sort of, 30, 40 billion. We're now up at around 80 billion a month. And those exports are all very high quality, high margin goods. For example, China is now the largest automotive, so the car exporter in the world. And that's actually quite an interesting theme that we like to focus on when we're building the Chinese part of our portfolios. But if we look outside of China to the broader sort of emerging and frontier markets universe, the two other sort of major markets of Korea and Taiwan also sold off because they're typically high duration, so with sort of long growth for a long period of time. But I think one of the markets that really bucked the trend was India, which actually posted positive returns, albeit slightly modest at 1.4% or so. I think the really major news on India is it was recently added to the JP Morgan bond index, which basically means that you're going to get a huge 20 to 30 billion inflows into the bond market. Yields are going to be lower, which is going to enable these companies to have even more growth. And I think generally countries like India, Indonesia are ones we really like because they're very much more classical emerging markets, driven by really strong economic growth, 5 to 6% GDP growth per year, and a rapidly growing middle class. And so as a consequence, these countries and the companies that we invest into within those countries are much more better insulated from the sort of global headwinds that we see everywhere else in the world.
Yeah, and if we speak about one of the smaller emerging markets, Turkey, it's small from a global emerging markets point of view, only 0.7% of the benchmark, but it's of course large for our Eastern European strategies. In Turkey, we had a lot of things happening. You're getting, for the first time in 10 years, an independent central bank hiking the rates up to 30%. This is very significant because the President Erdogan was against high interest rates, and now you're seeing that. And part of that is then the market started to perform. So the Turkish market was actually up 38% in dollar terms during the quarter. You are seeing some new IPOs. One of them is Ebebek. This is the largest children's goods retailer. It's a great company. I had a long meeting with the chairman and founder when I was in Istanbul, and we were the largest participant in the IPO. The stock gained 77% in 6 days. So this was one of the best IPOs we ever had in our part of the world. it delivered some 2.5% alpha to a number of Eastern European strategies. Also in terms of alpha or outperformance, this was a very, very significant contributor. So I think that's good to see that there's some action and something is happening in Turkey. A lot of people were very negative on Turkey if you would have spoken to them a year ago.
Sure. On a slightly less positive note, we got some quite worrying, scary data. I'd say actually that June, July, and August were the warmest by a very large margin on record globally. I think that's continued into September and October. It's now the middle of October. I'm in London. It'll be 24 degrees today, which is really quite scary. But I think from an investment point of view, really a reminder that climate investing is as much about adaptation as well as transition. You know, how are companies actually adapting to this much hotter environment already that we're seeing? Elsewhere in sustainability, we saw that this task force on nature-related disclosures finally published its final recommendations. It will take companies quite a few years to be able to sort of collect and publish this full disclosure, because there is quite a lot required, particularly on the geographical side, which is obviously so important. And just an example, GSK, who are a member of the task force, will be publishing their report in 2026. So we've got a while. We also published our impact report for our GEMS fund, our emerging market strategy, highlighting, for example, the carbon intensity of the fund is 49% below the benchmark, but hopefully more broadly explaining how we consider and measure impact within our strategy. And all these themes, impact, nature and climate, were very much in the spotlight in Tokyo last week, where was the annual UN PRI conference. Our Chief Sustainability Officer, Karin, was in the Global Advisory Group actually shaping the agenda and spoke. And I think the initial conclusion coming out of that, it was a much more sort of serious conference in terms of the depth and quality of the discussions, much more focused and hopefully much more actionable than we've seen in the past, which is great.
I think to wrap things up, it's going to be all about China, all about geopolitics during the fourth quarter. This will determine, I think, the performance of emerging markets. Having said that, you do make money when things go from horrible to bad. Maybe I shouldn't put it this way, but I think that the sentiment now in terms of geopolitics is really horrible. And once that starts to improve, this is when you make the large returns. I think if stocks are trading at 3, 4, 5 times earnings, it doesn't take much to move them 20-30% higher, right? You know, we don't know what then is going to happen, but I think I'm quite optimistic that at least just less news about China and Taiwan probably will bring all of the emerging markets quite a bit upwards. Having said that, the other issue is, as David pointed out, the high interest rates on the long-term bonds in the US. This just means that the discount rate is higher, stock valuations should be lower. So this is clearly something to watch for the fourth quarter.
So yeah, thank you very much for joining us, and we hope you found this session informative and gained a sort of good understanding of how we're looking at emerging markets and frontier markets and the direction we expect going forward.